Welcome back to Learn and Invest. Have you ever thought about it, putting money in the market, but something held you back? Well, those fears are valid. It is not a guaranteed machine. It has real risks. Now tell me honestly, have you ever thought about putting money in the share market, but something held you back? Maybe a friend lost money, or maybe you just did not know where to start? Those fears are valid. The share market is not a guaranteed money machine. Every successful investor knows these risks. That is the difference between someone who loses and wins. So today, we are going to break down the top risks. I will tell you exactly how to avoid each one. Stay till the end because the last point is very important. It is one that almost every new Indian investor misses. Let's start with market risk. Wars, elections, recessions can shake the market overnight. Sensex fell from 42,000 to 25,000. Investors who panicked locked in a loss. Their portfolio recovered. Let's start to avoid it. Wars: never invest money you'll need soon. Think long-term, 5 to 10 years. Invest through SIPs. Time in the market always beats timing the market. Next is liquidity risk. Imagine investing in a small company. One day you desperately need cash, but there's no one willing to buy. Volume matters. Some microcap stocks have very low volumes. You may be stuck with no exit. And a forced sale means a bad price. Always check liquidity. Here is how to avoid liquidity risk. Maintain a separate emergency fund. Only invest money you will not need soon. Stick to stocks with high volumes. The biggest risk is not the market. It is your emotions of greed and panic. Millions fall into the buy high, sell low trap. Do not invest based on tips. Here is how to avoid it. You can avoid emotional risks. Create a written investment plan. Define what and why you are buying. Determine your exit price and loss limit. Stick to the plan. First-time investors often make this mistake. They put all their saving to one stock, and then that company collapses. It has happened to thousands in India. Here is how to avoid it. Diversify to avoid concentration risk. Spread your investments across different sectors. For beginners, diversified funds are safest. Look for steady, smart first steps. Smart funds steps. Inflation risk means your money is shrinking. 1,000 rupees today buys less tomorrow. It quietly reduces your purchasing power. You must invest to beat inflation. Don't let it shrink. Inflation quietly eats your wealth. At 7% inflation and 5% returns, you lose purchasing power. Money on paper looks bigger, but it can buy less. Savings aren't enough today. You feel safe, but inflation is silently winning. How can we avoid this risk? Equity investments beat inflation over the long term. Nifty 50 gave around 12 to 14% annually. That is real return. That is real return. How can we avoid this risk? Equity investments beat inflation over the long term. Nifty 50 gave around 12 to 14% annually. That is real return. That is real return. These are traps. Hardworking Indians lose their life savings. If someone promises guaranteed returns, equity has no guaranteed returns, not even Warren Buffett. How to avoid fraud risk? Use only SEBI-registered brokers. Study company fundamentals and sector outlook. Shortcuts do not exist.
Financial education is one of the most important life skills. Like, subscribe, and share. See you in the next video.